So, and when we're talking about return on investment as well, could you break down to people, because I realized even when I bought my house, the concept of like mortgage, like down to the basics and how it works, because people think, okay, I'm gonna buy a house and then I'm gonna rent it out, and every month someone's paying me money, I'm not paying anyone else, you know what I mean?
Yeah.
They don't understand that.
Okay, fine. So, unless you're being a cash buyer, so a cash buyer is someone effectively, if you have a property that's worth 100,000, for example, and I have a cash of 100,000, that means that when I buy that property, I don't really owe anyone any money because that's been bought out for where it is. Majority of people can't afford to have that kind of money. So what they need to do is take a mortgage. Now, mortgage is effectively the bank lending you money towards the purchase of a property. So they have the criteria that you would need as an individual, as a group, would need to be able to fulfill. So that criteria could be the fact that you got a stable job. The amount that you need to borrow needs to be maybe 100 grand. So you might need to be on 20 grand or 25 grand per annum as a basic income, because they'll do multiples of 4 or 5 times your multiples to be able to afford to give it to you. They might also ask you to be able to provide at least 5 to 10% deposit if you're a first time buyer, for example. So that's what would be able to help you. Now, once you've bought the property and a mortgage company is giving you that maybe 80% loan to value, which is basically, if the property is 100,000, they're lending you 90,000. So your deposit would be 10,000, for example. So when they do something like that for you, that means that you still have to pay a mortgage of the 90,000, and that could be equivalent to maybe £300 a month that you have to pay Barclays, or you might have to pay Santander, or you might have to pay Lloyds each month from the property that you've just purchased. Yeah? And that could be over a duration of maybe 20 years or 25 years or 30 years and so forth. And they will add their own interest to it as well. So that's what you would pay. In return, if you decided you were renting it, you might want to rent a property that you're paying £300 for. You might want to rent it out for £600, if that's what the market value is, if you've done your calculations properly. So that means effectively you're going to be making £300 profit. Yes. So that's where that would engage, and that'll make the difference for you. So each month you get £300. You might have to obviously make sure you put some money away for maintenance. If you get electrical problems, someone's got to look after it and someone's got to pay for that. If the gas boiler's not working, someone's got to look after it and pay for it. And then you've got to pay for things like gas safe and make sure the electricals are running and things like that. So those are just little bits of money. So you might want to put £100 away each month, for example, for those kind of expenses, and then
to kind of maintain you, because as the landlord. So is it controversial to say, and I want to say this, is it controversial to say then you don't actually own the house then? Because I read somewhere where someone says you own the loan but you don't own the house, which I thought was funny. And I think it's a good distinction to make.
Absolutely. So as long as you haven't bought it all out, you don't own the house fully. No, you don't. But the benefit of that though is financially you're seen in the financial world as someone who's stable. Someone that you can go out and be able to get a business loan, someone that is credible, someone that can fulfill credit, because credit is a major issue for a lot of young people, especially if you're not paying your mobile phone bills, you're not paying your electric bills. These things are credit that goes against you. So you need to make sure your credit is good. The better your credit is, the better sort of product, mortgage products you can get. So what that means is, if the market is saying that interest rate at this moment in time on average is about 2% on average on your mortgage, and your credit isn't good, you might have to pay 4 to 5%. Okay, which then means that someone who's supposed to pay £300 for the mortgage is now paying £400 or £500 for the mortgage. But you're still getting £600 rent. So that's kind of depleted the £300 that initially you thought you were going to be earning. You're now only earning £100, and then you got to put that away for, the rainy day kind of scenario. So you're breaking even. So it makes no financial sense for you. But what can really work in your favor in that sense, because there's almost like 3 parts to property and investment, and we'll probably touch on that at some point. Property and investment is 2 different aspects. So there's a buy-to-let side of things where you look at the yield. So this is what you get on a monthly basis returned back. So when you pay your mortgage and you get £300 back, that's a yield. You're getting a percentage of yield back, so you can benefit from that. Then there's capital growth. So the capital growth looks at how much appreciation your property is from when you bought it to maybe the end of next year. So 12 months down the line, how much is it appreciated by. So if I bought it for 100,000, a year down the line, has it gone up by 102,000? Has it gone up by 105,000? So is your property now worth £2,000 more or £5,000 more because that's what you've made on it. So if the area is good, there's a lot of things coming into the area, activities, life, trains, transport, work, jobs, and it starts appreciating. A lot more people start moving into the area. That means that the value of your property will appreciate. So where you bought it for 100,000 is now a year down the line is now maybe potentially 120,000 in a year.
So when it's worth, sorry, I want to stop you there because I think there's a big confusion. I think people often throw around like, oh, I bought it for this much, now it's worth this much. So how would someone see that 20,000? Could you explain the process of how, if they wanted to see that 20,000 value, what would it be? They'd have to...
Okay, so effectively, if you want to see the value of that, you need to put it on the market.
Yeah.
So you need to get an estate agent, someone like myself also.
Definitely yourself. Yeah. They will come to you, bro.
Who would come to me and say to me, look, can you value my property for me? We'll give you a valuation. And then you potentially, if you wanted to take that money out, you couldn't take it all out. Because remember, the bank gave you 90%.
Yes.
Okay? So then you would need to be able to have, the bank would then send their valuers to make sure that what I've quoted is roughly the same ballpark figure. And they will do a loan to value. So they might say to you, okay, then what we can lend you is between 75% of the value of the property. So you can only get effectively 25% of it. Does that make sense?
No.
Okay. So if the property is worth 100 grand.
Yeah.
And it's been valued 120 grand. The bank may say to you, we've already lent you 90% towards it.
Yeah.
So you are owing us 90 grand.
Yes.
Right? But now you've appreciated by 30 grand. So what we're going to do is, rather than give you the whole 30 grand, we're probably just going to give you 10 grand. Because you still owe us money. So there's enough equity in there for us to be able to sell the property. And if the property if it down values, then we're still good.
Yeah.
Yeah.
No,
so they're protecting their own interest.
No, this is perfect because I think for the Instagram generation, it's always I bought a house, my house is worth this much. You know what I mean? But there's never any of this kind of detail into how this actually works. You know what I mean?
So how it translates is that if you want it to be hard cash, you're not going to get the extra 20 grand. They're not going to give it to you because they want to protect their interest. So their interest is we'll offset it. Maybe we'll give you 10 grand out of the 30 grand that you owe, for example. Yeah. So they will get their valuers to come around and value it for you. And then what happens is that 10 grand or 20 grand that they're given to you, they add onto the rest of the loan. Yeah. So now rather than you owing 90 grand, you owe them 100 grand.
Yeah.
Yeah?
Yeah.
But then the property is now 120 grand, so you're still better off because it's appreciated.
Yeah, because there's more in value.
Absolutely. But one of the best things is that you want to obviously pay off the capital as quickly as possible as well. Yeah. And then that gives you more leverage. So where they're 90 grand, lend you 90 grand, if you're paying off the capital, then it could be a year or two down the line, then the property value would appreciate it to 120 grand, but then the loan that you owe them may also get reduced to 85 grand.
Yeah.
Because you're paying off the capital.
Yes.
So you have more leverage in between it.
Cool. So now we're talking about like property as an investment, and I think there's a lot of rhetoric around it. So I watch this guy online. I don't really watch him, but he always comes up and he always says, don't ever buy a house. You know what I mean? Don't ever buy a house. And I think there's lots of different opinions, but he says because buying a house to rent is a good investment. But he says buying a house to live in it is kind of like you're not getting money off that investment. What's your stance on something like that?
I think it all depends on what stage of your life you're in. I think when you're young, I think if I could do this again, I'll probably buy properties as quickly as possible to be able to rent them out. So when I'm, ready to settle down, get married and all that kind of stuff and have kids and all that, I don't need to start stressing about where job is going to be, where work is going to be, where I'm going to get employment. I'll be able to sit down and get this residual income coming in.
Yes.
But there are tax implications to this as well, that you also need to make sure you get tax people to obviously look into your financial affairs and that. But that's what effectively I would like to do if I could have done it that way round. Because it gives you peace of mind. You're able to spend quality time with your family. You're able to do the kind of job that you want to do. You don't feel under duress. You've still got money coming in, so you can go on holidays and do all the things that you really want to do, right? And actually enjoy life and, live and not just work to live kind of thing, So that's what I would say to you. But going back to your question about whether it's worthwhile buying a house and then obviously living in it is not generating any income, these days a lot of people use things called HMO, which is house of multiple occupants. So if you have a house, a big house, and you've got 3 or 4 rooms available, you could potentially rent those rooms out to individuals that potentially like the location where you are, and if it's going to be £400 a room, you're going to make £800.
Yes.
Right? So that's income for you. So you can make money wherever possible.
Yeah.
It's whether you're willing to allow people to encroach kind of your environment or your space and that sort of thing. But if your house is big enough, why not rent a couple of